Hello friends, welcome back to part 26 of my Tesla earnings forecast video review series. I'm joined as always by my co-host Loki. You know, every time when I call out what part the video is, I just hope that I'm right about it. I think through all 26 parts of this so far, I've only mislabeled one of the videos with the wrong part number. If that matters to anybody, maybe nobody cares what part number each video is, but it helps me stay organized when I'm trying to upload them all to YouTube and to Twitter, which I have to do separately, and post about them to Patreon. There is a little bit of work involved in getting this content delivered to you folks. It's a labor of love, though. So it's been a while since I showed you the Twitter thread, the 69 tweet thread. The reason I'm showing it to you now is not because I think you're suddenly going to be able to read that print. You won't be able to. But just to show you what I said about the fourth and final stage of my detailed forecast model. It's just math. Every number in the third stage divided by every number in the second stage to get the detailed cost of sales percentages by forecast. Now, if you don't know what I'm talking about, that may mean that you didn't go back and watch parts 24 and 25 yet. So do that first before watching this video. But for each of these, I didn't really have a comment on them. They're just, hey, this is the math. These are the cost of sales percentages. Then right before the end, I said the very end has a total section, as all my stages of my detailed build-up have. And the section that follows that is the income statement, where our tour of this section of this tab began back on tweet 27. So tweets 27 through 69 were just this one tab in my spreadsheet, just to make the top half of the income statement. Yeah, that's true. So just to figure out how much revenue, cost of sales, and gross margin there's going to be, I did 1,150 rows worth of spreadsheet. Not every single one of which was critical in doing the calculation, but I like to have things organized and logically ordered. So we're going to be to the end of my 69 tweet thread by the end of this video is the point. And I ended my thread by saying I'll make one forecast video public per day, but my supporters will have early access as I upload them. You know, normally I wait until the end of the video before I say stuff like, be sure to like this video wherever you're seeing it. If it's on Patreon or if it's on Twitter or if it's on YouTube, click the like button. That's free. And thank you to everyone who supports me. I'm going to say this in the middle of this video instead of at the end, just because it's here in this tweet. Hey, if you want to see these videos on average a week earlier than the public does, you can subscribe to me on Twitter or on Patreon. Either way, I'll make the videos available to you the day that I upload them. I can't do it that way on YouTube because of the way the YouTube algorithm works. It needs me to make only one of my videos public per day at the pace that I'm recording them. I record all my videos in the weekend. Yeah, $4.20 per month at patreon.com or 69 cents per week as a Twitter subscription, which is $3 per month. So your better deal is Twitter, and you get subscriber exclusive tweets. I don't send a lot of those, but I do send some that are either too funny or too mean to publish publicly. So if those are interest to you, check those out. I wanted to say that because it's how I ended my Twitter thread. And with that said, let's keep going to stage 4 in my live Tesla earnings forecast model, where we have the cost of sales percentages. And just look at these. You know, base config for Model S is rising from Q1 to Q2 because of price cuts. There are people who accuse me of not putting the price cuts in. One Tesla Q hater / troll in particular is leaping to mind, who accused me of not putting the price cuts in my model. They're in. You can see them when you look in my model at stuff like this. Hey, the cost of sales percentage has risen from Q1 to Q2 for Model X and for Model S. Most people just aren't bothering to do a very detailed forecast model like I am that kicks out surprising stuff, like the ASP rising a little bit, a tiny amount, 0.1%, is what kicked out of my model. Now, I'm not promising Tesla will maintain revenue per vehicle or grow it by a tiny amount, but it could happen, is the point. It's not certain that Tesla's revenue per vehicle is going to decline by a lot from Q1 to Q2, and that is what a lot of the short sellers believe is going to happen. So they could be in for a rude awakening. On a per model basis, you can see that the profitability is getting worse here from Q4 to Q1 to Q2 before improving some in the latter half of the year, which is what Zach told us on the earnings call to expect. Then for the Fremont Model X, you can see it's the same story. The worst gross margins we're going to see for these vehicles individually is going to happen in Q2 and then improve some from there, right? For the Fremont Model 3, it's the same story. Higher cost of sales as a percentage in Q2 than it was in Q1. And for the Fremont Model Y, it's the same story, right? Because the entire quarter, the lower prices were available in Q1, Tesla did some initial price cuts and delivered some vehicles before cutting prices further. So they booked some of the revenue at the slightly higher prices, which is what's doing this. Because the cost of sales dollars ought to be getting a little bit better. It's the revenue that's getting worse, driving the cost of sales higher. But in Shanghai, it's a different story because Shanghai only managed 9 weeks worth of production due to holidays in Q1. They're getting 13 or 12, or maybe 11 and a half at this point. I don't know. I forecast it as 12 weeks of production. So that's what you're seeing here. They may have some Project Highland upgrade downtime to retool and prep to make that refreshed version of Model 3 and Model Y. If they make one for Model Y, they ought to. All we have for now is rumors, nothing official from Tesla. So that ought to get better, and that's what I'm forecasting. Same thing for the Shanghai Model Y. Not as good as Q4 of last year, but better by the end of this year. And with some of that improvement happening quickly because Q1 was such a bad quarter with so much factory downtime. Out of Shanghai. Let's go to the next section. What's happening with the Berlin Model Y? Well, it ought to be getting better because they ought to be producing more vehicles. Tesla keeps reporting that they're achieving higher and higher production output milestones, ticking off those ramping goals. And the more they produce, the lower their cost per vehicle ought to go. So if the revenue per vehicle isn't falling or is falling by less than the percentage that the cost of sales per vehicle is falling by, we should see cost of sales percentage improvement from really not very much profit at all at the end of last year, single-digit gross margin, to at least double-digit gross margin by the end of this year, even if it's less than a 20% gross margin. Tesla targets a better than 20% gross margin over the long term, and that's where I'm forecasting the Berlin Model Y to go in the long term, right? So by the end of next year, maybe a 30% gross margin possible. Let's scroll on down to Giga Texas and see the same kind of dynamic as Austin ramps up production of Model Y. I do have a little bit higher cost in Q2 than I had in Q1. What's driving this? Man, it's hard to tell by looking up the page, right? This one's flat, this one's down. Maybe I'll have to go check this one and see what's going on with this so that I understand. Well, maybe it's a full self-driving impact or something where these percentages don't tell you the story of what's happening. So there's maybe a mix weighting thing happening, but a little bit higher in Q2 before improving in Q3 and Q4. Interesting. I'll check that out after I finish recording the video. Cybertruck, what do we have for cost of sales percentages? Extremely high. Cost of sales percentages, 500, 300, 200, and then at the bottom line, over 100 until the second half of next year, and then single-digit gross margins toward the end of next year is what I expect for Cybertruck before it gets up to the designed factory output. Then for Semi, this is still a money-losing product at the gross margin line. For now, because these cost of sales are over 100%, that ought to improve toward the end of this year, is what I'm forecasting as they figure stuff out and streamline semi-production. Okay, so that gets us to the total cost of sales percentages by model. So we've got a leasing section here. These leased cost of sales look better because you're only accounting for a fraction of the cost of the vehicle, because you're going to have the rest of that cost come back to you at the end of 3 years and then need to sell the vehicle again as a used vehicle to recoup that remaining cost that you didn't really get revenue for from people who just made 3 years worth of payments. That's why these look better than they really are from a long-term business fundamentals perspective. You're getting the same profitability out of your leased vehicles after you sell them as used that you got out of your new vehicles that you sold to cash buyers. So the net present value of the cash flows you receive from buyers is similar whether you sell them for cash or as a lease. And that's how you price them to try and make sure you're getting just as much profit either way. So we've got Model S in total, kind of settling into that 82% range is what's in my forecast, with Model X a little bit better, around 80%. Model 3 hanging around 80%. Model Y a little better, highest volume model. A little bit more pricing power on the Model Y than you have in the Model 3. Probably about the same cost per vehicle, so that makes sense. Cybertruck pretty high, Semi pretty high. And that gets you to these total combined cost of sales percentages, including leasing. That's where you get to your totals. So what's the automotive gross margin shown here? This is just 1 minus the cost of sales percentage. That's how much money is left over after paying for the cost of producing and delivering these vehicles to their new buyers. So that number was higher last year than I'm forecasting it to be the rest of this year, and it's not close. I mean, I do have it improving, but I don't have it improving back to even the Q4 level, and the Q4 number, as you can see, was impacted by some discounting in the US. So automotive gross margin dollars, these are in billions of dollars worth of gross margin. It was higher in Q4 than in Q1, and it was higher than we'll see it in Q2. But this number ought to beat the prior year, which is the important thing. Up year over year in Q2, up year over year in Q3, up year over year in Q4 for gross margin dollars. This is what's going to help drive Tesla's earnings, because most of Tesla's gross margin is coming from automotive. Next we see the other divisions. Here's energy. Energy ought to get better. They ought to transition away from these single-digit gross margins to teens. Maybe a 20% gross margin by the end of the year is what I'm expecting, if Megapack sales can really pick up by quite a lot, and if Megapack can achieve these cost of sales percentages, which are quite a lot worse than zero-sum game 33 and JP Sart were telling people it would be in 2023 in December of last year and early this year, before zero-sum game 33 sold all of his call options for a profit. If you don't know what I'm talking about, I made a playlist about zero-sum game 33 videos you can go check out. That guy got very popular for a very short period of time with extremely bullish expectations for how profitable Megapack would be, how soon. And then those got shot down by Elon and Zach on the conference call, trying to lower people's expectations to a more reasonable level. What about services and other cost of sales? I have a little bit of improvement for this with scale. So as time goes by, those businesses ought to get a little bit more profitable than we've seen them in the past. And that's how you get to these total gross margin percents. We've seen these before, but here they are again. And with that, we have reached the end of the 69 tweet forecast thread review series. So thank you for watching, and Loki and I will see you in the next one. I do have to thank my executive producers, Kathy Kitchler and Rebellionaire.com, and I'll see you in the next one.